Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Sidus Space.
If you find our talks useful, please consider subscribe, like, and comment underneath. So, imagine intentionally gutting your own revenue, right? Like just deliberately tanking it, reporting a nearly $30 million net loss, and then somehow watching your stock price violently surge 47% in a single day.
Yeah, it's wild. It's a completely bizarre reality.
Right. But that is exactly the high-stakes situation we're unpacking today. We're looking at this aerospace turnaround story that is creating a massive, just glaring clash between really bearish fundamental headlines and wildly bullish technical price action.
Exactly. I mean, the divergence between the scary headlines and the actual money flow is the core of this entire situation.
Yeah, because if you track the space economy at all, or, if you just want to understand how wealth is built during massive corporate pivots, you really need to understand the mechanics of what is happening here.
Right, because traditional financial metrics are, they're screaming distress. Yet the market's actual behavior, where the institutional capital is actually moving, is signaling an aggressive growth phase.
Which feels super counterintuitive.
It does, yeah. But to position yourself effectively, you have to look past the superficial earnings numbers. You have to understand the physical infrastructure this company is putting into orbit.
Okay, so let's start with the intentional damage they're doing to their own balance sheet. Because to understand the explosive price action happening right now, you first need to understand the massive fundamental shifts the company is actively undergoing.
Right. It's a total pivot.
Yeah. They are purposely walking away from low-margin contract manufacturing. Historically, they built parts for other people. Now they're shifting entirely toward a highly scalable space-as-a-service data platform model.
And that phrase, space as a service, is really the key to the entire wealth-building thesis here.
Why is that? I mean, why is the old model so bad?
Well, building hardware for a third party is just a brutal, low-margin business. It's plagued by bidding wars. You build a part, you sell it once, you capture a tiny margin, and then, boom, you have to go find another contract.
You're starting from zero again.
Exactly. Every single time. What they're transitioning to is an architecture where they build the hardware once, keep it, and then sell the continuous stream of data it generates.
So they're selling the data to,
Maritime shippers, agricultural firms, defense contractors. It's recurring revenue.
Got it. It's like pivoting from being the contractor who gets paid a one-time flat fee to build a toll booth to suddenly becoming the entity that actually owns the toll road.
That's a great way to put it, yeah.
You're collecting a fee every single time a car passes by.
Right, and you can sell the data from one passing ar to 50 different buyers simultaneously. So the margins become structural, not just transactional.
Wow, okay. That makes sense.
But, to make that transition, they have to rip the Band-Aid off their legacy business.
Which is causing serious short-term financial pain. I mean, this pivot caused a deliberate 28% drop in their 2025 full-year revenue.
Yeah, 28% is a big hit.
Massive. They went down to about $3.4 million compared to $4.7 million in 2024. Because they're actively letting those legacy manufacturing contracts expire without renewing them.
And to a casual retail investor, scanning an earnings screener, a 28% revenue contraction looks catastrophic.
I would panic if I saw that.
Oh, for sure. It usually signals a company is losing market share. But you have to look at what is replacing that revenue on the backlog. While they were shedding those old contracts, they secured a $120 million Lunar manufacturing agreement with Lone Star Data Holdings.
Wait, $120 million? That dwarfs their old revenue.
It completely eclipses it, yeah.
But still, you can't build a toll road without massive upfront capital. If they're letting current revenue dry up while investing in future infrastructure, an investor's immediate panic should be bankruptcy, right?
That's the natural fear, yeah.
Yeah. And the headlines kind of validate that fear. They reported a net loss of $29.5 million for 2025. So tell me why a retail investor shouldn't look at that nearly $30 million hole and just run away.
Because you have to dissect the anatomy of that loss. Not all losses represent cash literally flying out the door.
Okay, unpack that.
Well, that $29.5 million figure was heavily weighed down by a $4.5 million non-cash impairment charge related to their LizzieSat-1 asset. Plus a massive increase in depreciation from deploying their new LizzieSat-2 and LizzieSat-3 fleet.
Hold on, let's slow down. Define what a non-cash impairment actually means for someone trying to figure out if this company will even be solvent next month.
Sure. A non-cash impairment is essentially an accounting adjustment. It just means an asset on their books isn't worth what they originally recorded, so they take a paper loss to correct the balance sheet.
Ah, paper loss.
Exactly. No actual cash left the company's bank account today because of that impairment. For an investor assessing survival, cash burn is what truly matters. When you strip out those non-cash charges, their adjusted EBITDA loss is $17.3 million. And that $17.3 million isn't just money evaporating into thin air.
Right, it's an investment.
Exactly. It is the deliberate infrastructure cost of building the new satellite network.
But $17.3 million in cash burn is still incredibly dangerous if you don't have the savings to back it up. How are they surviving that burn rate without drowning in, high-interest debt?
And that right there is the anchor of the bullish thesis. They ended 2025 with $43.2 million in cash.
Wow.
Yeah, that is a 175% increase from the previous year. It was driven by strategic equity raises that pulled in about $53.3 million. And crucially, they entered 2026 with zero outstanding term debt.
Zero term debt in a high capital expenditure sector like aerospace, that's really rare.
Extremely rare, and it changes the entire operational timeline. Look, in the space industry, capital's oxygen. By holding a $43 million war chest with no crushing interest payments owed to creditors, management has successfully removed the immediate solvency risks. They basically bought themselves the required runway to finish the transition.
So they can focus entirely on commercializing this new high-margin data model.
Exactly.
Okay, so the balance sheet is secured to fund the transition, which leaves the most critical question. Is the actual technology worth this massive financial sacrifice?
Right. Does the tech hold up?
Yeah, let's break down this space as a service model to see if it justifies the pivot. Because the space industry is notoriously fragmented. You usually have companies that specialize in one tiny sliver.
Oh yeah, it's totally siloed.
Right, like someone builds the sensors, someone else builds the chassis, a completely different company launches the rocket, and another company analyzes the data.
But Sidus Space operates with extreme vertical integration. They own the entire stack.
Really? All of it?
Yeah, they handle the manufacturing, the launch integration, the mission operations, and the final data delivery directly to the end customer. Retaining control over every step protects their profit margins from being chipped away by middlemen.
And they back that vertical integration up with 15 issued patents, right?
Yeah.
Supporting modular satellite manufacturing and AI-enabled payloads.
That's right.
But the core differentiator, the real edge they have in orbit, is their LizzieSat platform. It uses a software-defined architecture powered by the Orlaith AI ecosystem. Why is a software-defined satellite such a massive leap forward? I mean, what does that actually mean?
Well, traditionally, once you launch a satellite, its hardware is locked in space forever. It does exactly what it was programmed to do on the ground, and absolutely nothing more.
Makes sense. You can't just send a mechanic up there.
Right. So if a maritime shipping client suddenly needs a different type of imaging scan than an agricultural client, the legacy space company has to physically build and launch a completely new satellite.
Which takes years and millions of dollars.
Exactly. But with a software-defined architecture, they can execute dynamic, on-orbit upgrades. They can just push a software update to the satellite and change its mission parameters in real time.
Oh, wow. That adaptability is incredible.
Yeah.
But the AI payload is what really caught my attention. They are doing near real-time data analytics directly on the satellite.
Yes.
It basically eliminates the latency of waiting for ground-based processing. Let's make this tangible for a second. Imagine you are a logistics company trying to track a specific lost shipping container in the middle of the Pacific Ocean.
Okay, great example. So a legacy satellite would have to take a massive, heavy, raw image of the entire ocean, then beam that gigantic file down to a cloud server on Earth, wait in a queue to be processed, and then have an analyst physically scan it for the container.
That sounds slow.
It is. The bandwidth costs are astronomical, and the time delay could take days.
But with Sidus Space, the local AI chip processes that massive raw image right there in orbit. It identifies the exact shipping container, and instead of beaming down 10 gigabytes of raw ocean photos, it just beams down a tiny text file with the exact GPS coordinates.
In milliseconds.
Right. It's the difference between sending an encyclopedia through the mail versus just sending a text message.
And the implications for their competitive moat are massive. I mean, Traditional space companies are essentially flying flip phones in orbit.
While Sidus Space is deploying a network of smartphones.
Exactly. Legacy hardware competitors simply cannot match that level of responsiveness and data fidelity. The end customer, whether that's the Department of Defense or a private agricultural firm, is always going to pay a premium for immediate processed intelligence over delayed raw data.
Okay, so this brings us to the most fascinating part of the entire analysis. If the technology is this revolutionary and their runway is perfectly clear with $43 million in cash and zero debt, how is Wall Street reacting?
Oh, it's a battleground.
Right. We are witnessing a brutal fight between automated technical momentum and aggressive short sellers.
Let's map out the technicals first, because the charts are signaling a violent breakout. Back in January 2026, the stock hit a golden cross.
Okay, for those tracking the mechanics of technical analysis, a golden cross occurs when the 50-day moving average crosses above the 200-day moving average. It's not just a line on a chart, it is a hard-coded trigger.
That is a crucial point. A golden cross acts as a massive buy signal for institutional algorithms.
So the machines take over.
Pretty much. When those two lines cross, quantitative funds with automated systems immediately start accumulating shares. They don't care about the company's story or the earnings report. They just buy the mathematical momentum.
And that momentum recently caused the stock to surge over 47% in a single session.
Yeah. It is currently trading 61.1% above its 20-day simple moving average. And the relative strength index, the RSI, is sitting at a strong 67.93.
Now, that RSI indicates it is running hot, but not quite into extreme overbought territory yet. There is still room to run before a technical pullback.
Right, and the major resistance level we are watching is around $5.50.
But while the algorithms are aggressively buying this breakout, the short sellers are trying to destroy the narrative. Fugazi Research released a heavily bearish short report pointing out the severe shareholder dilution.
Yeah, they hammered on that.
They highlighted the 47.1 million shares issued in 2025 to raise that cash pile, plus a lingering $100 million at-the-market or ATM facility. But the real meat of the short report was the revenue concentration risk. Roughly 47% of their 2025 revenue came from a company called Craig Technical Consulting.
A company which happens to be a related party.
Wait, hold on. I cannot just let that slide. Craig Technical Consulting is owned by the Sidus Space CEO.
Yeah.
You are telling me the market just forgives half their revenue going to the CEO's own side company because they launched one new satellite? I mean, that sounds incredibly naive. How do we know this isn't just a temporary pump before they dilute shareholders again with that $100 million ATM?
Your skepticism is exactly what the short sellers are banking on.
Well, yeah.
But you have to separate the legacy corporate structure from the forward-looking cash flows. The market is a forward pricing mechanism, right?
Okay.
When institutional buyers look at that related party revenue, they see it as the life support system of the old business model. Craig Technical Consulting provided the baseline revenue to keep the lights on while they engineered the transition to space as a service.
So you are saying it doesn't matter anymore because the transition is complete?
Well, the market certainly believes the transition is validated. Despite the terrifying headlines in the Fugazi report, the stock rallied 9.39% on the exact day the short report dropped. That indicates massive institutional absorption of any panic selling. The reason Wall Street shrugged off the related party revenue is because LizzieSat-3 was just successfully commissioned in orbit. It publicly validated their sensing and imagery capabilities to the broader commercial market. Plus, they locked in that $120 million external contract with Lone Star.
Okay, I see. So the narrative shifts from where did the 2025 revenue come from to we know exactly where the 2026 and 2027 revenue is coming from. Massive third-party contracts.
Exactly.
But what about that $100 million ATM facility hanging over investors' heads? If I buy today, aren't they just going to dump shares on my head tomorrow?
The urgency to tap that ATM at low prices is gone. With $43 million in cash and zero debt, management has the luxury of patience.
Right. They don't need the money right now.
Exactly. An ATM facility is typically used strategically when the stock price is much higher, which actually supports the thesis that the company expects further upward valuation. The dilution from last year was just the brutal toll required for survival and transformation. The market views the current cash pile as an adequate buffer against future dilution risks.
And the broader analyst community really aligns with that forward-looking view. We're seeing analyst targets sitting between $8.50 and $10, while the stock is currently trading in the $3 to $3.50 range.
Which is a huge upside.
Yeah. They also recently added 2 new board members, Tiffany Norwood and Kella Wendling, adding serious aerospace and financial credibility.
And, institutional comfort is a prerequisite for major fund inflows. The heavy volume of options trading we're seeing flow into the stock suggests that larger players are positioning themselves for a fundamental re-rating of the company's entire valuation.
So, knowing that volume is flowing in, let's map out the exact dates and catalysts you need to monitor. If you are an investor building a strategy around this stock, how do you manage the risk?
Good question. Let's look at the timeline.
In the short term, Q1 2026 earnings are the next major hurdle. Investors are going to demand to see the initial third-party revenue contributions from the newly commissioned LizzieSat-3. They want hard proof that the space-as-a-service model actually generates external cash.
Right. And following that, Q2 2026 brings the anticipated launch of LizzieSat-4, which will feature advanced integration with Maris-Tech payloads, expanding their AI edge computing capabilities even further.
Then, moving into the medium and long term, late 2026 brings development milestones for LizzieSat-5, which is their dedicated lunar asset. But the massive speculative catalysts like the events that could alter the valuation overnight are the defense and macro tailwinds.
Oh, absolutely.
They are an awardee on the massive $151 billion SHIELD IDQ defense contract. Now, no task orders have been issued to them yet, but government officials have suggested that orders could begin flowing by Q3 2026.
And securing even a fraction of a percent of a $151 billion pie represents a sudden structural step up in revenue.
For sure.
And on the macro side, NASA's Artemis II mission is creating tremendous sector-wide tailwinds. The global focus is returning to the moon. Because they hold that $120 million lunar manufacturing agreement with Lone Star, they are perfectly positioned to monetize the emerging lunar data economy.
Okay, based on this timeline, the imminent Q1 earnings, the Q2 satellite launch, and the late 2026 defense contract potential, how should an investor actually approach this? Is this a quick technical day trade to ride the momentum of the Golden Cross, or is this a multi-year hold? Walk us through the wealth-building strategy.
Synthesizing the technical breakout with a fundamental backlog, the final thesis arrives at a 7 out of 10 bullish rating.
Okay.
However, because of the historical volatility, it requires a dual-natured strategy. I classify it as a speculative swing to long-term hold, targeting a 6 to 12-month horizon.
Break down the risk management of that dual strategy. Like, how do you size and manage a position like that?
Well, the immediate play, the swing aspect, involves capitalizing on the current technical breakout fueled by sector rotation. And short sellers being forced to cover their positions.
Right, the short squeeze element.
Exactly. A common strategy here is to take initial profits when the stock hits that $5.50 resistance level to protect your capital. But you don't close the entire position. You leave a smaller percentage of your initial shares to hold through this 6 to 12-month window.
Because that 6 to 12-month window is when the true wealth-building event happens. That is when we find out if the SHIELD task orders materialize and if LizzieSat-4 successfully launches.
Right. If they execute on those late 2026 milestones, they permanently transition from being a high-risk turnaround story into an established, highly profitable space data utility. You trade the technical momentum now to generate cash flow, but you hold portion for the fundamental execution of their new business model.
To summarize the overarching theme here, Sidus Space is a fully funded, vertically integrated turnaround story actively breaking out of its legacy shell. They absorbed the pain of dropping their low-margin revenue, they diluted early to build a $43 million war chest, and now they are deploying a revolutionary AI-powered software-defined satellite network that legacy competitors just cannot easily replicate.
And yeah, the market environment is chaotic right now.
Yeah.
But the trajectory is clear if you understand the mechanics of the transition.
Yeah.
The short sellers are hyper-focused on the boarded-up windows of the old business model, while institutional money is actively pricing in the high-margin data network that is currently coming online.
Exactly. And that leaves us with a final concept I really want you to mull over as you research this sector. Think about the broader Artemis economy and the return to the moon.
It's massive.
It is. When we look back at the early internet boom, the most massive generational wealth wasn't always created by the flashy websites everyone was logging into. It was created by the companies quietly laying the fiber optic cables, building the routers, and constructing the data centers, the infrastructure.
Yeah, the picks and shovels.
Exactly. Right now, the public is entirely focused on the giant rocket launches, the fire, the noise, the spectacle of it all. But who is quietly building the invisible infrastructure for this new space data rush? Who is putting the AI servers in orbit so that the lunar economy actually has a functioning digital network to rely on?
It's a great question.
When you start looking for the companies building the invisible web above our heads, the entire space sector looks completely different. Keep your eyes on the data.